Is that this is a masterstroke of market. Fiscal year 2026, analysts project one architecture and leveraging billion sophisticated capital is positioning itself and has dropped to 6.3% for
segments. The entire capital structure becomes precarious, total bank debt and convertible notes.
Who is buying every single stock? Who is really behind the dark pool activity? Watch until the end and you will find out more.
When we examine the off-exchange dark pool volume in late February and early March of 2026, a highly specific market microstructure emerges regarding supermicrocomputer. If you isolate the $32 to $32.25 price band, we see exactly 4.97 million shares traded in dark pools compared to just 2.59 million on the lit exchanges. That represents a 65.72% dark pool concentration, which frankly is staggering. And if we look at the derivative market on February 26th, we saw massive volume of 199,539 option contracts. That represents roughly 20 million underlying shares with call volume at 61,561 against put volume of just 27,142. These microstructure metrics, they force us to look at the broader fundamental situation as of the first quarter of 2026.
Right.
We're witnessing an entity that has evolved from a specialized motherboard manufacturer into a primary orchestrator of the global AI infrastructure system. But this brings us to the core disagreement we really must explore today. Is the company's recent financial trajectory, specifically its massive 123% of revenue growth to $12.7 billion against a severe gross margin compression down to 6.3%, is that evidence of a brilliant, long-term razor and blade strategy to capture the liquid cooling market? Or does it expose underlying structural vulnerabilities and pricing weakness against larger competitors? My perspective is that this is a masterstroke of market share capture. They are trading short-term margins to secure the physical server footprint required for the inevitable high-margin liquid cooling transition, and this is backed by sovereign-grade institutional conviction.
And my perspective is that the margin collapse to 6.3%, compounded by a heavy $4.9 billion debt load, and quite frankly, lingering governance concerns following an auditor resignation, presents an incredibly fragile risk profile, especially in the face of established giants like Dell Technologies.
To really unpack what is happening here, I think we have to look past the surface-level panic regarding that margin compression. Yes, the gross margin has dropped to 6.3% for the second quarter of fiscal 2026. That is down from 9.3% in the first quarter and 11.8% the year before. On paper, sure, that looks like a severe bleed, but I argue that the 6.3% margin is the razor in a classic razor and blade model. They are practically giving away the server racks, the razor, because they are deliberately pricing their systems aggressively to win the enterprise footprint right now.
I understand the analogy, but you're asking the market to accept a massive upfront sacrifice based on a promised future payout.
Because the payout is technologically guaranteed. The blade, the mechanism for future profitability, is the high-margin liquid cooling infrastructure. They call this their data center building block solutions, or DCBBS. Physical thermodynamics will demand this for next-generation chips, like NVIDIA's Vera Rubin and AMD's Helios. The physics are undeniable. Air cooling simply can no longer mitigate the heat these new processors generate. Management estimates these liquid cooling segments carry gross margins above 20%, and they plan to double the profit contribution from this segment by the end of 2026. And the thing is, sophisticated institutional capital sees this clearly.
Well, do they? Because the price action over the last year has been heavily contested.
Just look at the massive buying during the stock's 40 to 50% consolidation period. Consider the Canada Pension Plan Investment Board, or CPPIB. They increased their position by 344.23% in a single reporting period, holding over 3.6 million shares. That is sovereign-grade conviction in the long-term infrastructure play. They recognize that securing the hardware footprint today guarantees the high-margin service and cooling upgrades of tomorrow.
I hear that masterstroke argument, but I approach that margin collapse with far more skepticism. You simply cannot call a drop from 11.8% down to 6.3% during a booming $12.7 billion quarter a calculated victory. To me, that indicates something fundamental about the balance of power in the industry right now. It suggests that the hyperscale customers, the massive tech companies actually buying these servers, have captured the pricing power, not the infrastructure provider.
A part of that margin hit was the cost of expedited shipping. They were spending capital to meet incredibly urgent demand to secure those hyperscale contracts.
Exactly. But if your product is truly highly differentiated, you don't absorb those expedited shipping costs to the point of having your own gross margin. You pass those costs on to the buyer. Relying on future liquid cooling profits as the blade is highly speculative, especially given the fierce competitive landscape. We aren't operating in a vacuum here. We're talking about Dell Technologies sitting on a staggering $43 billion AI backlog, with established global enterprise relationships and massive economies of scale. Furthermore, to support this massive inventory requirement, the company has taken on significant capital structure risk. They executed a $2.3 billion convertible senior note offering due in 2030, and they utilized Rule 144A to do it.
Which is a completely standard mechanism for raising capital quickly.
Standard, yes, but it bypasses standard public registration to sell directly to qualified institutional buyers. That is a huge amount of hidden leverage injected into the system. When you add that to their existing bank debt, you are looking at a $4.9 billion total debt load. That is an incredibly precarious position, especially when coupled with the recent governance crisis, where Ernst & Young resigned over internal controls, forcing a transition to BDO USA.
I see why you frame the margin decline as a capitulation to the hyperscalers, and yeah, the debt load certainly adds pressure. But let's pause and examine the physical reality of the transition we are in. You characterize the liquid cooling thesis as speculative, but it is a physical inevitability. As I noted, the heat generation of upcoming AI processors simply cannot be handled by traditional air conditioning in a data center. By leveraging their inventory strategy, which is effectively a multi-billion-dollar war chest of components, they guarantee first-to-market delivery for architectures that are evolving every 12 to 18 months.
Being first to market doesn't matter if you are selling at commodity margins.
But the margins won't stay commodity. Once that server footprint is secured inside a data center, the liquid cooling upsell becomes a captive market. Think about the engineering. You don't bring in a secondary third-party vendor to cool a tightly integrated short-depth system that is built on a 900 gigabyte per second NVLink interconnect. The cooling is inherently tied to the hardware design. This is why the aggressive pricing to win business is a strategy, not a weakness. You lock them into the ecosystem.
But is it a sustainable strategy? We must look at how the broader analyst community views this exact timeline. Goldman Sachs maintains a sell rating with a $27 price target, specifically because the timeline for this promised margin recovery is far too uncertain. When you aggressively price servers to win business, you are actively training your largest clients to expect commodity pricing moving forward. And yes, physics dictates that heat must be managed. But peers like Vertiv specialize entirely in thermal management and critical infrastructure. Dell, Arista Networks, they are all adapting rapidly. The assumption that the provider of the server box automatically wins the high-margin cooling contract assumes a level of vendor lock-in that hyperscalers actively, aggressively fight against.
So you think the major institutions are just misreading the room?
I think the street is demanding proof. JP Morgan and Citigroup have lowered their price targets to the $39 to $40 range, precisely because they are waiting for actual evidence that this liquid cooling transition will translate into higher profitability rather than just more top-line revenue at the exact same commodity margins.
I'd argue the evidence of sustainability is actually embedded in how sophisticated capital is positioning itself right now. Let's return to the dark pool microstructure we opened with. For the listener, dark pools are essentially private exchanges where institutional investors trade massive blocks of shares without tipping off the broader market and causing massive price swings. We aren't just seeing passive anchoring from Vanguard with their 68.8 million shares or BlackRock with 63.8 million. We are seeing relentless accumulation by active managers who deeply understand the underlying value. Look at the 71.09% dark pool concentration in that narrow $31.75 to $32 band.
Wait, let's pause on that. High dark pool volume doesn't automatically mean long-term believers are quietly accumulating stock.
How else do you interpret nearly 5 million shares moving off exchange in a highly specific price band? Consider Fred Martin's disciplined growth investors. They increased their holdings by 608% in late 2024 and have continued to accumulate, holding nearly 10 million shares as of February 17, 2026. Westfield Capital Management just initiated a new $17.2 million position. These institutions utilize dark pools to execute these trades precisely because they are building foundational, long-term positions in the solid plumbing of the AI boom.
I have to reframe how we interpret that dark pool and institutional flux, because you're painting it entirely as a bullish indicator. You mentioned the 4.97 million shares traded in the dark pool in that 32 to 32.25 range. The organizations behind many of these trades, market makers like Citadel Securities and Susquehanna International Group, or SIG, they are in the business of providing massive liquidity. And often that liquidity is necessary to facilitate exiting funds who are mandate constrained and looking to offload millions of shares without crashing the bid price. Furthermore, let's look at the derivative sentiment, the options data from early March 2026.
The 199,000 contracts I mentioned?
Exactly. Yes, we saw $13 million in call premiums, bets the stock will go up, versus $4.62 million in put premiums. And these were characterized by unusual whales data, sweeps or blocks exceeding $20,000. But to me, that suggests high beta speculation. This is traders anticipating a short-term trend reversal off a 20-day moving average bullish crossover. It is not necessarily stable long-term infrastructure investment. It's traders playing the extreme volatility of a $27 billion market cap company that recently suffered a 40 to 50% price decline.
That's an interesting point regarding the high beta speculation in the options market. And I grant you that short-term volatility attracts day traders, though I would argue the underlying operational catalysts support a much longer-term thesis, specifically the pivot towards sovereign AI and AIRN.
The telecom and nation-state deployments.
Precisely. The company is actively diversifying away from those exact hyperscalers that you rightly pointed out possess immense pricing power. The announcements at the Mobile World Congress in Barcelona in March 2026 were definitive. They aren't just selling boxes to big tech companies anymore. They are building national-scale infrastructure. Look at the Hay skiing cluster deployed for SK Telecom in South Korea. We are talking about utilizing over 1,000 AI servers built with NVIDIA Black-Shell GPUs for GPU-as-a-service model development, or the collaboration with Telenor to launch Norway's first sovereign AI cloud, which ensures data security and compliance within national borders. This proves they are winning complex, high-margin deployments entirely beyond the traditional hyperscalers. Their ARS-111 LFR short-depth systems are specifically designed for the unique physical constraints of telecom edge workloads. This is highly specialized, deeply integrated engineering, and that commands a premium.
I accept the technological achievement here. Integrating NVIDIA Grace and Blackwell architectures into short-depth systems with Bluefield data processing unit support, that is technically demanding. It requires serious engineering chops. But we cannot separate these massive sovereign deployments from the systemic risk of governance.
You are going back to the auditor issue?
Because you have to. A sovereign nation building a domestic AI cloud prioritizes security, compliance, and trust above all else. Ernst & Young did not resign over minor accounting disagreements. They raised serious concerns regarding governance, transparency, and internal control over financial reporting. This led directly to a delay in filing the annual report and the 10Q.
But the independent special committee formed by the board reported in late 2024 that they didn't find any evidence of material inaccuracies that justified the resignation, and they fully cleared the integrity of senior management.
A self-appointed committee clearing their own management team only goes so far in the eyes of Wall Street compliance officers. For the massive institutional buyers you referenced earlier, the mandate-constrained pension funds, they simply cannot fully commit, or in some cases even legally hold the stock until those SEC filings are entirely normalized. The remediation plan is still just that, a plan, to be reviewed at the virtual annual meeting.
Which brings us precisely to the catalyst that will clear that exact overhang. Management's alignment with shareholders during this entire governance transition has been absolute. Insider activity is a critical metric to watch here. Founder Charles Lang maintains ownership of over 66 million shares. His personal net worth remains almost entirely tied to navigating this specific cycle successfully.
Founders holding stock isn't exactly a revelation.
But look at the broader executive team. Look at Sarah Liu's activity on February 27, 2026. She exercised employee stock options to acquire 20,980 shares at $4.235 per share. And critically, she retained them rather than selling on the open market. That demonstrates profound internal conviction during a period of intense external volatility. The appointment of BDO USA to complete the fiscal 2026 audit, the expansion of the board with new independent directors, these are concrete structural steps. The April 15, 2026 shareholder vote to ratify BDO USA will be the pivotal event that clears the delinquency overhang and allows that sidelined institutional capital to flood back in.
I'd be very careful reading too much into that insider retention. Insider holding of that magnitude is standard for founders. They rarely liquidate their core holdings during a depressed price cycle because it would signal total capitulation and crater the stock entirely. But the sheer scale of the capital structure risk remains untouched by who sits on the board. We are talking about $4.9 billion in total bank debt and convertible notes. That $2.3 billion convertible note offering due 2030 was upsized, meaning the initial purchasers exercised their full $300 million option.
Which shows demand for the debt.
But those qualifying institutional buyers are betting on the company's ability to convert that debt into equity down the line, which strictly requires a rising stock price. If that April 15th milestone falters, or if they file the delayed reports and the margins haven't fundamentally improved, or if they miss that promised 20% margin target for the liquid cooling segments, the entire capital structure becomes precarious. Yes, they have $4.1 billion in cash on hand, but in an industry where chip architectures evolve entirely every 12 months, that cash will be burned rapidly just to maintain the massive inventory war chest you praised earlier.
I think it's important to look at the quantitative projections that counter that specific fear of cash burn and margin failure. Despite the bearish sentiment from firms like Goldman Sachs, the long-term earnings growth forecast remains incredibly robust across the broader street. For fiscal year 2026, analysts project $1.86 in earnings per share, growing to $3.11 in fiscal 2027 and $3.54 in fiscal 2028. You couple that with a revenue forecast exceeding $40 billion for fiscal 2026, and it strongly suggests the land grab strategy is actually succeeding.
Projections are just models. They aren't cash in the bank.
But they reflect the underlying math of the business model. Firms like Northland Securities and Argus Research maintain targets as high as $63 to $64, precisely because the forward PE and EV to EBITDA ratios, essentially how the company is valued relative to its raw earnings power, are remarkably low if you model in the successful execution of that 20% liquid cooling margin. The modular design of their data center building block solutions allows for extreme customization and rapid time to market. That is a structural advantage over standardized systems. It will allow them to capture the high-margin integration revenues when the Vera Rubin and Helios platforms finally launch.
A $40 billion top line is undeniably impressive. Nobody is arguing they aren't moving incredible amounts of product. But a top line without pricing power is just revenue moving through a very expensive debt-burdened pipeline. But tension between the growth thesis and the margin reality is exactly why the consensus recommendation from 15 brokerages in March of 2026 is merely a hold, with an average 12-month target of $43.43. You rely incredibly heavily on the transition to liquid cooling as the savior of profitability. But again, deploying prefabricated modular AI data centers in partnership with Schneider Electric, or building turnkey enterprise AI platforms with vast data. These require massive upfront capital expenditures.
Which they are currently making.
Yes, but if Dell, with its $43 billion AI backlog and immense enterprise support network, decides to compete on price in the liquid cooling space, just as it has in the core server space, the expectation that margins will magically expand back to 20% may prove to be a severe miscalculation.
Let me synthesize where my perspective settles after examining these dynamics. The 6.3% gross margin we saw in the second quarter of fiscal 2026 is not a symptom of structural failure, but a deliberate, strategic sacrifice. By utilizing their modular architecture and leveraging billions in inventory to bypass global supply chain bottlenecks, they have uniquely positioned themselves at the exact physical bottleneck of the AI boom, cooling the next generation of computing. The sovereign-grade accumulation by institutions like CPIBB, the relentless buying by active managers like disciplined growth investors, and the heavy, deliberate dark pool accumulation in the $32 band all point to sophisticated capital looking past the short-term noise. They recognize that once the governance overhang is cleared with BDO USA this April, the company is structurally guaranteed a dominant, highly profitable position in the late 2026 liquid cooling cycle.
And my synthesis maintains that while the $12.7 billion quarterly revenue, a 123% year-over-year increase, is undeniable, the severe erosion of pricing power simply cannot be ignored. Dropping from an 11.8% to a 6.3% margin while absorbing expedited shipping costs suggests capitulation to larger buyers, not a calculated strategy. When you combine this intense competitive pressure from Dell Technologies with a $4.9 billion debt load, heavily reliant on convertible notes, the execution of this razor and blade strategy becomes incredibly narrow and fraught with risk. The reliance on the upcoming April 15 shareholder meeting to resolve the fallout from the Ernst & Young resignation underscores exactly how fragile the institutional trust truly is right now.
It is clear, however, that we both acknowledge the underlying physics of this technological transition. The heat density of upcoming accelerators makes liquid cooling an absolute, non-negotiable necessity for future data centers.
Yes, I think any observer has to concede that point. The thermal realities of the next generation of GPUs cannot be solved with traditional air conditioning. The physics demand a new solution. And we certainly agree on the sheer scale the company has achieved. A $12.7 billion quarter establishes undeniable mass in the global supply chain. They are a major player, without question.
The true test of this transition and the ultimate validation of either the bullish infrastructure thesis or the bearish margin warning will hinge entirely on the events of the coming months. The April 15, 2026 meeting will dictate the restoration of institutional compliance, and the subsequent delivery of the Vera Rubin and Helios platforms later in the year will finally prove whether those high-margin liquid cooling profits actually materialize. The data we've explored today offers profound insights, leaving the listener to carefully weigh the sovereign-grade institutional accumulation and physical necessities of AI against the compressed margins and debt structure to form their own judgments on the true value of this infrastructure orchestrator.
If you like this content and want to watch more videos like this, then don't forget to subscribe. Thanks for watching. See ya!